Hi guys, happy Thursday. It is December 15, 2022. So just wanted to do kind of a market analysis and a trade recap here. I'm actually currently short the S&P 500 here. I'm in some puts and just wanted to give you my thoughts on where we are since I posted that post FOMC video yesterday and the results of the FOMC and the reaction that we saw in the market. So just roll the intro real quick and we'll jump right in. All right, guys, so welcome back once again as we continue to put in new lows here. The market is definitively showing us that the sellers are in charge. So one of the things that obviously we were facing this morning is we opened with a considerable gap down after the FOMC yesterday. The big takeaway from the FOMC was that the interest rates were increased by 50 basis points, which was as expected. However, I think what caught investors by surprise was that the terminal rate went up. And what that is basically telling us is how many further interest rate hikes are likely in the future, essentially. I think a lot of investors were kind of cheering and hopeful that, the interest rate hikes might be coming to an end somewhere after the first quarter of next year, but the terminal rate coming in higher than expected is indicating that interest rate hikes are likely to continue well into next year. So that apparently has to be repriced into the market as we look for more interest rate hikes than obviously was expected. Additionally, the language that the Fed used has not changed, and the market was very closely tuned into that language. Now, we also did have some catalysts that came in today. Core retail sales came in lower than expected, so obviously that is negative. That indicates, pressure on the economy essentially slowing, showing some of that slowing. Initial jobless claims also came in lower than expected. So that could indicate it's kind of one of those situations where positive news is bad news in this market. So that could also indicate that we are seeing persistently stubborn employment that is not slowing, which the Fed is trying to slow the economy, trying to slow that employment growth down in order to get inflation under control. So they're definitely struggling to reach that goal through these interest rate hikes. And then the Philadelphia Fed manufacturing numbers also came in lower than expected. So some of the things that I was looking at today, I had some demand zones and supply zones marked out where I would want to be considering getting long and short. One of the key levels here that came into play today was this 39.0542. It's a big monthly reversal level. And I just kind of made a note to myself that, no longs are allowed below this. So once we start confirming below this level, I'm no longer looking for longs. I've got some supply levels to the upside. If we had gotten up there, obviously those were well out of the picture with the gap down that we saw today. So I'm actually short underneath of this 39.0542, and the targets here per my trade plan is the 38.84 to the 38.64. I think it's possible that we could hit one or both of these targets today. It would be quite a move down, though, especially given the gap. So if we calculate the gap into the stats, it's going to be exceeding the ATR for the S&P 500 for the day. But given where we have actually opened and given what I'm seeing in the internals, it's one of those days where it could happen. I mean, the internals are incredibly bearish right now and continuing to increase. So we're looking at negative 8.7 to 1 on the breadth for the NYSE and negative 2.7 to 1 on the NASDAQ. Anything below, negative 1 to 1 is bearish. So we're looking at negative 8 to 1. Okay, so just for reference there, I'm looking at the tick on the NYSE. I've only seen two 15-minute candles closing above the zero line. Again, that's very, very bearish. Cumulative tick is building to the downside, which is indicating to me that the majority of the stocks in the New York Stock Exchange are continuing to sell off. Additionally, the advanced decline line on the S&P 500 is just hovering down around negative 460. So essentially 460 stocks out of the 500 that are in the S&P 500 are selling off. Every single sector except for real estate is red from the open. Again, just indicative of that weakness. The VIX is back up to around $22.67 so far on this sell-off. So it hasn't been a super volatile sell-off. It's been pretty orderly. You can see that we did have the best bounce of the morning was off of that monthly level that I marked out at 39.0542. I did try a long off of that level. I got a little bit of profit out of it before I got stopped out on the profit stop. Once we confirmed underneath of that level right here on this 5-minute candle, we got this first 5-minute candle that closed on a new low below that level there. I was able to get short at the open of this candle right here. Paid myself something into the 38.90 level, which is kind of like a psychological level. Anytime you're around a whole number, this 3,900, 10 over, 10 under is always a psychological level. So took some profits there, and I'm still holding the rest. I'm looking for, go to the 30-minute here. We've got pivot support sitting here at 38.84. This is where I want to take off a good chunk of my position, and then if we can fill, or if we can not fill, I should say, if we can get down to this unfilled gap below us, excuse me, at 38.64, that's going to be another spot where I think we probably would find a bottom for today anyway. So that's the picture of what I'm looking at here on the S&P 500. I did take a couple of longs this morning, so I'm basically in a spot where I'm having to dig a little bit out of a hole. Let's see, it was on this chart, yeah. So we had, jump over the 4-hour chart here. So we had, right here, we had a reversal level on ES at 39.6725. And if we go back to the 5-minute chart here, you can see that right here, this was right at market open. The best chance for a bounce at the market open was ES opening right over that big 4-hour level there. So you can see that this was the opening candle here. I was able to get a long right into that. However, the next 5-minute candle came down and it just bottom ticked stopped me. I mean, literally got a bottom tick stop out right there, and then it sucked right back up above the level. So I got back in here once we opened over the level. Unfortunately, this one I was able to stay in the trade on this wick, but you can see the next candle we got the confirmation and the breakdown below that level, and that's where I actually got stopped out at. I should have gotten in short here. However, I was looking at SPX at the time, and that was coming into right here where we had support at 39.21. So it was just a little too close. The risk to reward just wasn't there for me at that point to get in. Obviously, looking at in hindsight, you know, how far we went, the risk to reward was clearly there. But I decided to play it safe, sit on my hands. I didn't want to just be jumping in stuff, you know, right after taking 2 losses in a row, trying to catch a long there. When I look at this in hindsight, we, you know, on the daily, with the size of this gap down, and let me go ahead and turn on the moving averages too for a little bit of context here. And let's just hide all the drawings so it kind of cleans up the chart a little bit. But when we look at this, obviously we have rejected that downtrend line. We've rejected the 200 moving average. We were trying to hold over the daily 9 and 20 here, but when we open with this gap down underneath of the 9 and the 20, you know, confirmation of under that 200, it just made sense that, you know, it should have been nothing but a sell day. You know, obviously you can see where we have pivot levels of support coming in here around that 3,900 level. But once we started breaking that, I mean, that pretty much for me was the writing on the wall. So it was just a matter of getting in short and, you know, just riding the train down at this point. Now, another thing, and this is what I'll wrap up with here. So if we go back to, it's this ES chart, in the 4-hour time frame, this is one of the things that I talked about last night, was the fact that we've been holding this very nice positive slope from the low that we established this year off of that 3,500 level. And every time we've come into the bottom of the slope, you can see we have bounced off of it very nicely. So it's been very well respected. Well, today we got our first 4-hour candle right here that has closed underneath of the slope. Okay, and now we have our second 4-hour candle that is continuing to move lower. So I think that the likelihood that we see continuation lower is, you know, obviously there. I mean, we have broken this positive slope at this point. I think that, you know, we've got some clear areas of demand down here around 3,800, 3,750. Of course, we will probably find some areas to bounce before that, but I think it's very likely that we continue to see lower prices. Whether we get down to this low around 3,500 again this year or next year, or if at all, remains to be seen, of course. We'll just have to take it one level at a time. But for me, at this point, from a macro perspective, I want to be nothing but short. I mean, we have clearly broken this positive slope. So there's just simply no reason to be looking at longs. I'm sure we'll get some nice cover rallies, but they will just be that. They will just be cover rallies to reload for the short. So that's what I'm looking at today, guys. That's where I'm currently sitting. And with that, I hope you guys are doing well yourself. I hope you enjoyed this video. Be sure and leave me a like and comment below. I always appreciate that. And with that, take care, and we'll see you in the next one.